I need to share something with you that most people aren't paying attention to. Something that's happening right now in the bond market that has preceded every major economic catastrophe of the last 100 years. And this time, it's worse than it's ever been. I'm talking about the yield curve inversion. And if you don't understand what that means or why it matters, you need to listen carefully. Because what's coming could make 1929 and 2008 look like dress rehearsals for the main event. My name is Bill Ackman. I run Pershing Square Capital Management, a hedge fund that manages billions of dollars. I've been investing for over 30 years. I've lived through multiple market cycles. I've made very public bets that have paid off spectacularly, and I've made mistakes that cost hundreds of millions of dollars. But through all of it, I've learned to read market signals. And right now, every signal I'm seeing is telling me we're heading towards something catastrophic. Not a correction, not a bear market, a systemic crisis that will reshape the entire financial landscape. Let me start by explaining what a yield curve inversion actually is, because most people have no idea, and the financial media does a terrible job of making it clear. The yield curve is simply a chart that shows the interest rates on government bonds of different durations. Normally, longer-term bonds pay higher interest rates than shorter-term bonds. That makes sense, right? If you're going to lend money to the government for 10 years instead of 3 months, you want to be compensated more for tying up your money for longer. That's a normal, healthy yield curve. But sometimes that relationship flips. Short-term rates rise above long-term rates. That's an inversion. And when that happens, it means something is very wrong. It means that bond investors, the smartest money in the world, are so worried about the immediate future that they're demanding higher returns for short-term lending than for long-term lending. They'd rather lock in a rate for 10 years than lend for 6 months. That's how scared they are of what's coming in the near term. And historically, when this happens, a recession follows. Not sometimes, not usually, always. Let me give you the track record. In 1928, the yield curve inverted. The stock market kept rising for another year and a half. Everyone thought the economy was invincible. And then 1929 hit. The market crashed 80%. Banks failed. Unemployment reached 25%. The Great Depression destroyed a generation's wealth. In 1973, the curve inverted. Months later, the economy was in crisis. Oil prices quadrupled. Inflation spiraled. Stocks crashed. It happened again in 1980. Same result. Recession. Then 2000. The dot-com bubble was at its peak. Technology stocks were trading at insane valuations. The yield curve inverted, and within months, the bubble burst. Trillions of dollars evaporated. Then 2006, the housing market was booming. Everyone was getting rich, flipping houses. Subprime mortgages were being handed out like candy. The yield curve inverted. And 18 months later, we had the worst financial crisis since the Great Depression. Every single time, without exception, the yield curve inverts and a major economic crisis follows. It's the most reliable recession indicator we have. And right now, we're in the longest, deepest yield curve inversion in modern history. Longer than 2008, deeper than 1929 in some measures. And yet most people are ignoring it. They're looking at the stock market hitting new highs and assuming everything is fine. They're making the same mistake that's been made before every major crash. They're confusing the delay with a reprieve. Here's what people don't understand. The yield curve doesn't tell you when the crisis will hit. It tells you that a crisis is inevitable. There's always a lag. Sometimes 6 months, sometimes 18 months, sometimes longer. But it always comes. And the longer the inversion persists, the worse the eventual crisis tends to be, because that delay allows imbalances to build. It allows people to take on more risk. It allows leverage to accumulate. It allows the problem to get bigger and bigger until something finally breaks. And right now, we're in the danger zone. The yield curve inverted in mid-2022. We're now over 2 years into this inversion. That's approaching the historical timeline when recessions have hit after past inversions. But here's what makes this time different and potentially much worse. The amount of debt in the system is unprecedented. In 1929, total debt to GDP in the United States was high, but nothing compared to today. In 2008, we had a housing debt bubble, but today we have debt everywhere. Consumer debt is at record highs. Corporate debt is at record highs. Government debt is at record highs. We're talking about over $90 trillion in total debt in the U.S. economy. That's 4 times GDP. 4 times. And here's the problem with debt. When interest rates are low, debt is manageable. Companies can borrow cheaply. Consumers can afford their mortgages and car payments. The government can service its obligations without breaking the budget. But when rates rise, everything changes. And rates have risen dramatically. The Federal Reserve took rates from basically 0 to over 5% in less than 2 years. That's the fastest rate hiking cycle in 40 years. And all that debt that was accumulated when money was free now has to be refinanced at much higher rates. Think about what that means. A company that borrowed money at 2% interest 5 years ago now has to refinance at 7 or 8%. That's triple or quadruple the interest expense. Many companies can't afford that. We're already seeing an increase in corporate bankruptcies. Commercial real estate is getting destroyed because office buildings that were financed at 3% are now being refinanced at 7%, and the cash flows can't support those payments. Consumer credit card debt is over $1 trillion, and the average interest rate on that debt is now over 20%. People are getting crushed, and the government, the U.S. government now owes over $34 trillion. The interest on that debt is approaching $1.5 trillion per year. That's more than we spend on defense, more than we spend on Medicare. It's becoming the single largest item in the federal budget. And as older, low-interest debt matures and gets refinanced at today's higher rates, that interest burden is only going to grow. We're approaching a point where interest costs could consume 20 to 30% of all tax revenue. That's unsustainable. Something has to give. Now, the optimists will say, Bill, the economy looks strong, unemployment is low, GDP growth is positive, corporate earnings are good. Why are you so worried? And my answer is simple. That's what it always looks like, right before the crash. In 2006 and 2007, the economy looked fantastic. Unemployment was under 5%. The stock market was hitting record highs. Corporate profits were strong. Housing prices were soaring. And then 2008 happened, and all of that strength evaporated in a matter of months, because the strength was built on a foundation of debt and speculation. And when that foundation cracked, everything came down. We're in the same situation now. This economic strength is an illusion. It's being propped up by deficit spending and by the lagged effects of previous stimulus. During COVID, the government pumped trillions of dollars into the economy. Stimulus checks, expanded unemployment benefits, PPP, loans. All of that money created a cushion that's been supporting consumer spending for the past few years. But that cushion is gone now. Excess savings have been depleted. Credit cards are maxed out. Delinquencies are rising. And once that support disappears completely, you're going to see the real state of the economy. And it's not pretty. I want to focus on a specific area that I think is going to be ground zero for this crisis: commercial real estate. This sector is sitting on a time bomb. During the pandemic, work from home became standard, and it's not going back. Companies have realized they don't need massive office spaces anymore. Employees have realized they're more productive at home. Office occupancy rates in major cities are still 30 to 40% below pre-pandemic levels, and they're not recovering. This is a permanent shift, but here's the problem. All of these office buildings are financed with debt, billions of dollars of debt, and that debt was based on assumptions that the buildings would be 90% occupied and generating stable rental income. Now they're 50% occupied, rents are falling, and the loans are coming due. In 2023 and 2024, we've seen the first wave of commercial real estate defaults, but the big wave is coming in 2025 and 2026. That's when hundreds of billions of dollars of commercial real estate debt matures, and the buildings can't be refinanced because they're worth less than the outstanding loans. When those defaults happen, who takes the losses? Banks. Regional banks in particular are heavily exposed to commercial real estate. We already saw the canary in the coal mine in March of 2023 when Silicon Valley Bank, Signature Bank, and First Republic all failed within a few weeks. Those failures were triggered by interest rate risk and deposit flight. But the next wave is going to be triggered by commercial real estate losses. And it's going to be much bigger because the total exposure is in the trillions, not billions. And here's where it gets really scary. The banking system is interconnected. When one bank fails, it creates fear about other banks. Depositors start pulling their money out. That creates liquidity problems for other banks, which forces them to sell assets at fire sale prices, which creates losses, which creates more fear. It's a vicious cycle, and once it starts, it's very hard to stop. The Federal Reserve can step in and provide emergency liquidity, but they can't prevent losses. They can't make bad loans good. They can only delay the reckoning. The yield curve is telling us that this reckoning is coming. Bond investors see the same things I see. They see the debt, they see the commercial real estate problems, they see the stressed consumer, they see the government deficits, and they're positioning for a crisis. That's why they're accepting lower long-term rates, because they think the Fed is going to have to cut rates dramatically when the economy falls apart. And they want to lock in today's rates before that happens. But here's the catch. The Fed might not be able to cut rates as much as the market expects because inflation is still a problem. Core inflation is running above 3%. That's well above the Fed's 2% target. And some of the forces driving inflation, like deglobalization and energy transition costs, are structural. They're not going away. So the Fed is trapped. If they keep rates high to fight inflation, they'll break the economy and trigger a debt crisis. If they cut rates to save the economy, they'll let inflation run hot and destroy the currency. There's no good option. That's what makes this situation so dangerous. Let me tell you what I think is going to happen. I think we're going to see a rolling crisis. It's not going to be one dramatic crash on one day. It's going to be a series of failures and breakdowns across different parts of the economy. First, you'll see more commercial real estate defaults. Then you'll see regional bank failures. Then you'll see consumer credit problems as people can't pay their car loans and credit cards. Then you'll see corporate bankruptcies as companies can't refinance their debt. Then you'll see municipal debt problems as cities and states lose tax revenue. Each of these will feed into the others. And at some point, the whole thing will cascade into a full-blown crisis. The stock market is going to get crushed. We're talking about a decline of 40 to 50% from the peak, maybe more. because valuations are extremely stretched right now. The S&P 500 is trading at over 20 times earnings. That's well above historical averages. And that's based on earnings that are probably overstated because they don't fully account for the impact of higher interest rates on corporate profitability. When earnings start missing estimates, and they will, multiples are going to compress. You're going to get hit with both falling earnings and falling valuations. That's a double whammy that can easily take the market down 50%. Bonds aren't going to provide safety either. Long-term bonds might rally if the Fed cuts rates aggressively. But if inflation stays high, bond returns are going to be negative in real terms. Your purchasing power will be destroyed even if your nominal value holds up. And if we get a sovereign debt crisis, which is possible given the government's fiscal situation, even U.S. Treasury bonds might not be safe. That sounds crazy, I know. But look at what happened in the UK in 2022 when the gilt market almost collapsed. It can happen anywhere if the debt burden becomes unsustainable. So what should you do? First, reduce your exposure to risk assets. If you're fully invested in stocks right now, you're taking on way too much risk. Move some money to cash. I know, cash doesn't pay much, but it gives you optionality. When the crisis hits and assets go on sale, you'll want to have dry powder to deploy. The best investments I've ever made were during crises, when everyone else was panicking and I had cash to buy. Second, avoid long-duration assets. Don't own long-term bonds. Don't own high-valuation growth stocks that are priced for perfection. These are the assets that get hit hardest when rates stay elevated and growth disappoints. Focus on quality. Companies with strong balance sheets, low debt, stable cash flows, pricing power. These businesses will survive the downturn and come out stronger on the other side. Third, consider alternative stores of value. I'm not a big gold bug, but I understand why people are buying gold right now. When you don't trust the currency and you don't trust the government's ability to manage its debt, gold is one of the few assets that's not someone else's liability. Real assets in general, commodities, infrastructure, things with intrinsic value are going to hold up better than financial assets. Fourth, if you have debt, pay it down. This is not the time to be leveraged. If you have a variable rate mortgage or a home equity line of credit, pay it off or refinance it into a fixed rate. If you have credit card debt, get rid of it. High interest rates on consumer debt are going to be crippling in the years ahead. You don't want to be stuck with that burden when the economy weakens and you might lose your job. Fifth, prepare psychologically. This is going to be hard. Watching your portfolio decline 40 or 50% is traumatic. People make terrible decisions when they're scared. They sell at the bottom. They lock in losses. They miss the recovery. If you prepare mentally now, if you accept that a major decline is coming and you plan for it, you'll be much better positioned to handle it when it actually happens. Look, I'm not trying to be a doomsayer. I'm not rooting for a crash. I'm invested in the markets too. A crash is bad for me and bad for everyone. But I'm a realist. I look at data, I study history, and everything I'm seeing tells me we're heading for a major crisis. The yield curve inversion is just one signal, but it's the most reliable signal we have. And it's been flashing red for over 2 years now. The difference between 2008 and today is the scale of the problem. In 2008, we had a housing bubble. It was big, but it was contained to one sector. We could bail out the banks, recapitalize the system, and move on. Today, the bubble is everywhere. It's in stocks, it's in bonds, it's in real estate, it's in corporate debt, it's in government debt. There's nowhere to hide. And that means there's no easy bailout this time. You can't print your way out of a problem when the problem is too much money printing. I think when we look back on this period, we're going to see it as the culmination of 40 years of bad policy, 40 years of artificially low interest rates, 40 years of deficit spending, 40 years of encouraging debt instead of savings, 40 years of financial engineering instead of real investment. All of that is coming home to roost. The bill is due, and it's going to be paid by everyone who didn't prepare. The yield curve is trying to tell us something. It's trying to warn us, and we should listen. Because in every previous case, the people who listened and prepared were the ones who survived and even prospered. The people who ignored it were the ones who got wiped out. History is very clear on this. The question is, will we learn from history or will we repeat it? Right now, it looks like we're going to repeat it. And that terrifies me because this time, the consequences are going to be worse than anything we've experienced in our lifetimes. The yield curve doesn't lie. And right now, it's screaming at us. The only question is, are we listening? Let me address one more critical point. The global dimension of this crisis. In 1929, the crisis was largely concentrated in the United States and Europe. In 2008, it was a global crisis, but the emerging markets bounced back quickly. China launched a massive stimulus program. Commodity prices recovered. Growth returned. This time, there's no cavalry coming to the rescue. China is dealing with its own massive debt problems. Their real estate sector, which is 40% of their economy, is in free fall. Europe is in worse shape than we are. Japan has been in a debt trap for 30 years. There's no growth engine left to pull the world out of this. And that means when the crisis hits, it's going to be truly global. Supply chains will be disrupted, trade will contract, currency markets will be chaotic. Every country is going to be trying to save itself, which means protectionism, capital controls, competitive devaluations. It's going to be ugly. And there's no international coordination to manage it. The institutions that were built after World War II to prevent these kinds of crises, the IMF, the World Bank, the G20, they're all weakened and dysfunctional. We're on our own. This is why I keep coming back to the yield curve. It's not just predicting a U.S. recession. It's predicting a global restructuring of debt and economic relationships. And that restructuring is going to create massive disruption and massive opportunities. If you're prepared, if you understand what's happening, you can position yourself to benefit. But if you're caught off guard, you're going to be swept away by forces beyond your control. The choice is yours. But the clock is ticking.